Ever wondered how to measure a company's profitability on a per-share basis? One way to do it is by using a financial metric known as earnings per share, or EPS. This metric represents the portion of a company's profit that gets allocated to each outstanding share of common stock. It's a key indicator of a company's profitability and is widely used by investors and analysts in financial analysis. Now, to calculate EPS, one needs to divide the company's net income by the weighted average number of outstanding shares. Net income, also known as profit or earnings, is the total income of a company after all expenses, taxes, and interest have been deducted. It's the company's bottom line and is a key indicator of its financial health. On the other hand, the weighted average number of outstanding shares represents the average number of shares of common stock outstanding during a specific period, weighted by the time those shares were outstanding. This accounts for any changes in the number of shares over the reporting period, like stock buybacks or issuances. There are two types of EPS, basic and diluted. Basic EPS considers only the actual number of outstanding shares and is calculated by dividing the net income by the total number of basic shares. Diluted EPS, on the other hand, takes into account potential dilution from securities like stock options, convertible bonds, and convertible preferred stock that could be converted into common stock. It provides a more conservative measure of a company's earnings per share. A higher EPS indicates higher profitability, and investors generally view this positively. It means that the company is generating more earnings for each share of stock. Furthermore, EPS allows investors to compare the profitability of different companies, especially within the same industry, providing a standardized measure for evaluating performance. Analyzing changes in a company's EPS over time can reveal trends in its profitability. Consistent growth in EPS is often seen as a positive sign. Investors often consider EPS when making investment decisions, as it contributes to various valuation metrics such as the price-to-earnings ratio, which is used to assess the relative value of a company's stock. However, it's important to consider the quality of earnings contributing to EPS. Non-recurring or one-time items may distort the picture. Analysts often adjust earnings for extraordinary items to get a clearer picture. Different industries may have different typical EPS levels, so comparisons should be made within the same industry for a more meaningful analysis. Also, be aware that companies may engage in activities like share buybacks to artificially boost EPS, so it's essential to consider the overall financial health of the company. In conclusion, earnings per share is a crucial metric that provides insight into a company's profitability on a per-share basis. It is widely used for financial analysis and plays a key role in assessing a company's performance, making investment decisions, and comparing companies within an industry.